So what's up everybody? Hopefully everybody has had an amazing day. This video is gonna be real in depth, and matter of fact in this video we're gonna go in detail about my model, or rather models. So we're gonna talk about the execution model, how I focus on probabilities, and how I structure my thinking in first, second, and third underlying dynamic principles, moving also over to confirmation to the second underlying dynamics, and talking about these different things. Um, but also talking about essentially what my model is, what it's based on fundamentally, technically, but also based on sentiment and flows, and which sort of things all of these things does. But as you will see, my principles is essentially based on first, second, and third underlying dynamic principles. So whenever you hear those, we always start with first, then go over to second, then go over to third, then go over to fourth. So it's layers on layers on layers on layers, which then gives us a good direction based on probabilities, where we employ the technical model based primarily on technical analysis. That's why I say 80% is based on fundamentals, sentiment, and flows, okay? While 20% is just based on technicals. So let's just dive right into that video. Into this call, okay? And I'm just gonna start by showing everybody in this video, essentially, since we have, alright, and since we are to focus on over essentially my model today, and since I'm not gonna go in detail about going into detail about these individual concepts, rather I'm gonna focus on the holistic view of my model and the purpose it fulfills for me. Um, you will be able, I just need to show you, you'll be able to find overall the individual, right, the individual videos, like going into, for example, I'll just show you them. So going into detail about, for example, understanding probabilities and why it's so important, because we're going to talk about the structure today, and we're going to talk about all of this, okay? And then we're gonna go in detail about like how this all goes together, like pretty much how my model enables me to find probabilities and scenarios to predict moves, essentially. Okay, but what all of this is more or less built up on, so more or less COT, this is an individual call, going in detail talking about COT. This is an individual call talking about market structure, right? This is an individual talking about standard deviation and the levels I use. This is essentially a video going in detail about how I use fundamentals and the macro sort of layers I use, essentially. So the first underlying dynamic principles. Well, this is the video about more or less understanding data and how essentially I use data. This is another video for macroeconomics, essentially all the macroeconomics I use. And this is, of course, how I simply turned a simple liquidity sweep, right, essentially, to the pretty much a market beating edge, okay, and how essentially you can do the same, okay. And today we're gonna put this all together, okay, put this all together, okay, and we're gonna talk about essentially, rather than the individual concepts, the holistic process I use, okay. So the holistic process for me to be able to make scenarios in the markets, essentially, and then how I use to trade these models, essentially these scenarios, okay. And I use the STA to trade these different scenarios, and I trade the most probable scenario. So yeah, let's just dive right into this video there. So just starting off, as I've already said multiple times, okay, what do I always do in the beginning? Well, the thing I always do in the beginning is focusing essentially on the first underlying dynamic principles. It's something I'll name the first underlying dynamic principle. Now there's a lot of other things, okay. I'll show you all the first underlying dynamic principles. You can see them right here, so you can look at all of these things, okay. And all of these is just some sort of first underlying dynamic principle. Of course, like stock rate is not, it's just confirmation to the second underlying dynamic principles. But like interest rate differentials, you have here, you have yield, essentially the yield curve, inverse yield curve. You have you have the Fed's balance sheet, you have overall Fed's total assets, you have the euro dollar differentials, the PPP value, you have the money supply versus inflation, you have consumer price index compared to PPP, or PPP trend compared to CPI. Okay, you have a PPI, I'm sorry, year over year leading indicator versus consumer price index, and of course the money supply as well. So money supply forecasting, PPI forecasting, CPI essentially. You have CME Fed Watch, you have US German 10 bond yield spreads, and you have fundamental index. You have Euro fundamental index. So all of this is just pretty much PPP. This is another flow. This is just for ETH and crypto essentially. So flows and sentiment, these are, I should organize these in much better, like first underlying dynamic, second and third underlying dynamic principles here. But I'm not done that yet. But however, if you're in big to macroeconomics, I would definitely recommend you guys to sign in and essentially potentially look at buying what is it called, like subscribing to macro micro, okay? Because essentially this is what all essentially fundamental, like if you're big into fundamentals, right, global trends, etc., macroeconomics, for example currency trading, but also using it for indice trading, like if you're trading essentially indice futures, so Nasdaq, S&P 500, any other stocks, or just into economics in general, this is the best website. They have essentially have everything, like all the tools you essentially need to understand macroeconomics, okay? But also to like all indicators like yield spreads essentially, and like I said, I'm not going to go into detail about what these tells you, okay? Instead I'm going to focus on the holistic view. And so moving forward, like moving on to what's most important and why I'm essentially in TradingView here, that's just because in here you have macroeconomic, essentially macroeconomic data, okay? You know, all of this is essentially data points, okay? And the first thing I'm always doing is focusing on macroeconomics. That's the first underlying dynamic essentially. That's the core principle. That's the thing that from macroeconomics, if I just understand the macroeconomic world trend, okay, and going into individual trends like US trend in macroeconomics, and especially monetary policy in that macroeconomics, like understanding what the Fed is doing, because that correlates quite a lot to currency movements. Then I have like a big building stone of essentially the model I'm trading, right? Because essentially that gives me a framework to work with. So the first thing first underlying dynamic, that's the thing I'm doing. First underlying dynamic. Whenever you have any problems or want to find the overall trend in things, since everything needs to follow, you know, physics principles, everything, you know, you cannot break the laws of physics. The markets cannot break the laws of physics. It needs to follow these higher time frame trends. And you'll find these higher time frame trends by looking at macroeconomics. Like I said, I showed you 2 videos where I go in detail about these macroeconomic things I use, essentially 2 of them. I use so many more. Like I showed you, I use like 20, 30 more things. But don't go overly complex on this shit. It's very, very easy to find macroeconomic trends, and I'm showing you it just afterwards. But one thing I go in greatly, okay, as I said, like majority of the focus is not essentially on news trends. It's not on macro clusters. It's not on news. It's not on the quantitative data of news. Instead, it's on what these news provides me in terms of how they change any central bank's monetary policy. What I mean by that is I'm not focusing on the individual, and I should not even give you this information, but essentially markets, I believe, does not move dependent on news events. They move dependent on how these news events impact monetary policy, because the real news does not impact the real supply demand dynamics of the currency. Instead, the monetary policy is what realistically, in real terms, determines the supply demand characteristics of the currency. What I mean by that is that all currencies and everything, all assets, even though it's a fiat, like what people call fiat currencies, um, even though they print it, it still has a supply and it still has demand. Okay, there's central bank demand for currencies in terms of trading and other foreign large institutions. There's always going to be demand for a currency. For buying, for example, treasuries. For you to buy U.S. treasuries, you need to convert your money to U.S. dollars and this is why I call it lock it up, like for you to buy bonds, essentially treasuries, which is a characteristics that you're locking up dollars. You're essentially locking up the demand, right? So the demand for dollars may stay the same, but the supply may diminish, which means that the currency should go up higher. So these are the things you should directly look at. Okay, you should not look at essentially things that does not have this impact. But what I'm trying to focus on is the things that has an impact on the real supply demand characteristics of a currency for me to determine, since supply and demand is literally basic laws of physics, right? And since not anything can break laws of physics, this is essentially just helping me to gather the overall trend. Okay, so the overall higher time frame trend, essentially, so long-term trending of movements in currencies, right? So it just helps me build these core principles. Like I said, first underlying dynamic equals first principles, essentially. From there I can build other things on it. Okay, but I need a basic and real good understanding of first underlying dynamic principles. Okay, and one of those principles, once you have talked about essentially macro trends, etc., and how that determines essentially the monetary policies of central banks, is then interest rate differentials, which is a huge direct supply demand, has direct supply demand applications for currency specifically. So let's say, if you can see here, the US has much more and much higher of an interest rate than the euro, then that would directly imply that the dollar should be more attractive, to hold, essentially. And I've covered this in great detail multiple times over. If you have not, essentially listened into this and understood it just a little bit, you have to go back, like I said, into the videos where I show you it all, okay, where I talk about it real time, essentially, and give you guys my long-term perspectives, etc., based on what we are doing now, which you can then go in and reverse engineer if you want to. Like, you maybe don't want to understand this macro trends and long-term understanding of where markets is going just based on basic physics principles, but this helps me a lot. Okay, this helps me get a clear mind. Okay, something that I can always go back to if I'm lost, essentially, in the markets, which helps me with determining overall bias and essentially a probabilistical view of where we should go higher time frame. Like I said, it gives me a base from the base I can look at other things. Okay, so that's just something I need you guys to understand. But then you can also, of course, go into the interest rate spreads and the individualistic central bank monetary policy. So for example, now, like I said in yesterday's video, I don't know, hopefully you guys were here, we have seen, and this is just an example of this, okay, we have seen a shift, right, in essentially the forecastings for the hard data. You can see this is the hard data, this is the numbers, right? The numbers tells us that the yield differential is huge between the USD and euro, okay, which is the hard numbers. It's the interest rate differential you can see right here. So we have 4.5 and then 2.15, okay, which means that the USD should be much more attractive holding than euro. But then you can go into forecastings behind the forecasting, so etc. This is essentially just pure fundamental hard quantitative data, but then you can go into soft data behind it, like the dot plot charts of the individual central banks, in which you can see the ECB has actually switched to a more hawkish stance compared to the US. So even though the ECB has a lower interest rate at 2.15, okay, forecastings show that the Fed now is going to do an aggressive rate cuts here. Okay, it's going to start with an aggressive rate cutting cycle, while the ECB is going to stay at these 2.15 rates for longer, because before Fed was hawkish and ECB was dovish, but now those two have flipped. So now the ECB is hawkish or more hawkish than the Fed, and the Fed is more dovish, showing us that interest rate will go down for the US while ECB interest rates will stay the same, meaning that we're going to find some sort of equilibrium in the future. Since the markets is sort of forward looking, you can devise a model to determine where prices should go, and that's why I'm pretty much switching my stance. I was long term, really realistically really bullish since I think like June or something like that this year. That's when I saw a floor coming in dollars, and you saw how that went. It went pretty good. And then I was from June to just 3 or 4 weeks ago, long-term bullish on dollar, but now I switched that to long-term bearish. I like long-term bearish, okay? I was not long-term bullish for dollars. I was like 1, 2, 3 months bullish for dollars, and that's exactly what we've seen. But now it's shifted it a little bit. So, this is why you need to be updated with my videos, because in those I go in through the macro trends, but now you might be understanding them a little bit. But like I said, first underlying dynamic principles just tells me long-term trends. Long-term trends of where CPI may go depending on PPI, and CPI determining monetary policy, etc., etc. Or essentially where GDP will go, if GDP will be it will go up, or if we're going to potentially see a countdown to recessions, if where Fed's cutting cycle is essentially to go, forecastings on that. And I'll just show you one right here with a CME Fed watch. This is all first underlying dynamic principles, all which I'm showing you right here in just a second when it shows up. Like you can see here, it's all first underlying dynamic principles. It all just gives me a base of where to look at things from here. Okay, now let's just then therefore go down to the second layer, okay, or the layer above the first underlying dynamic base, okay, which I call the second underlying dynamic. It's essentially looking at short-term factors or intermediate term factors having a direct and real impact on supply demand characteristics of currencies, okay, so of euros, of dollars essentially. And this is essentially looking at the most important of those things mentioned above. So if I have first underlying dynamic principles, okay, those determines the long-term trend, because those determines the long-term supply demand characteristics of a currency. However, now we go down into short-term supply demand characteristics of a currency, okay, and one which has real supply demand implications, as I said, is the second underlying dynamic. You can see second underlying dynamic here, and that is specifically the yields and the bonds, okay. This is the most important interest rate, okay, and I use individualistic concepts on the yields, on the bonds, on other bonds, right? For example, the DE 10Y, okay, the German 10Y yield, okay, and for example, US government 10-year-old yields, 30-year-old yields, 2-year-old yields, and I use these to essentially make real-time sort of, you can even call it calculations, okay, into the real supply demand characteristics of these individualistic currencies, okay. But like I said, this is why we use yields, okay. Yields are just there for us to determine short-term supply changing dynamics dependent on real-term and real-time implications of monetary policy changing day to day, but also, of course, going in detail about what other people think, because what yields is, right? And I'll just cover this once and only once, okay? And then you'll have to really listen to this essentially. So this is essentially the most important call of this. How you find a thing which has real implications on supply demand characteristics. So let's say yields essentially stop having such an important supply demand characteristics in the future, which it will. Think of when interest rates is 0, okay? Think of the implications that will have on yields. So all of these forward indicators, like short-term second underlying dynamic indicators, will change, okay? And how you find new ones and or find better ones is by breaking it down to physics principles. It's thinking about, well, why is actually determining supply demand characteristics for a currency? Well, in some aspects, in some crises, oil can be one, okay? It's simply something which has demand for. Okay, why essentially um, yields as is such an important thing is because, well, the bond market is essentially one of the biggest markets in the world, right? The bond market. Okay, and what the bond market is essentially US government debt, okay, which is essentially the biggest debt in the world, okay. And if the yield therefore increases, aka the yield you get for holding bonds increases, well, there's going to be more, probabilistic or higher demand for that currency because they want to lock it up. And central banks, smart central banks, will eventually lock it up, meaning it's a leading indicator. So if the yield goes up, well, most likely you'll see the currency of the desired country go up. Now, this is different because when yields go up for DE10Y, you usually also see yield going up for US10Y, okay? And if that happens, you see dollar going up. So in some cases, when this goes up and this goes up at the same time, you see dollar going up while foreign currencies goes down. But now, as you can see these days, where we see yield going down, while um, while overall you see the correlation markets of German 10 decouple and essentially going up instead. You can see it goes up today while yield's going down for the US. That would drive down the dollar, okay, and definitely drive up the euro, okay, and or any other counterpart, which is yield spreads, which is also part of the second underlying dynamic. Think of this, super cool things, right? So essentially, this is the second layer, often, let's say Earth, okay, which I showed you previously. So hopefully, is it totally clear for everybody as of yet, like essentially what I'm doing? So essentially, first underlying dynamic gives me base, second underlying dynamic gives me movement, and now we go into the third underlying dynamic. But is it clear for everybody right now? If it's not clear, you should go in and check the individualistic videos because I've done one on first underlying dynamic, a little bit on second underlying dynamic, and I've not done one yet on third underlying dynamics or some of the third underlying dynamics such as COT. But let's just go in then and talk about the third underlying dynamic, which is the second, or I mean the third layer, okay? And the third layer is just confirmation. So it's essentially just confirming which, because I can know where the dollar will go, like long term. But essentially, I also need to know which currency and which sort of FX or let's say NASDAQ or ES will be best to execute on. I need to know the one with the biggest strengths or weaknesses, okay? And therefore, I use correlationary markets. So then I can use oil, gold, silver, platinum, and or other third underlying dynamics such as home builders or the Wix, Euro AUD, Euro GBP, okay? Because if let's say Euro GBP goes up, okay, and you see essentially the dollar going down, well, then you should not be taking buys on GBP. Instead, you should take buys on Euro. So super simple. You're just looking at correlations. So third underlying dynamics is all about correlations. Okay, but now I need a way to confirm that these correlations and that these essentially supply demand characteristics is the same thing that the central bankers and or other institutions is looking at the same thing as me. So I need even though I could be essentially right on fundamental principles, like I can be right on macroeconomic trends, I can be right on these things, etc, 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 but I'm a trader, okay? I don't want to essentially be first. Instead, I want to know if the where the movement is going to be, because I cannot take advantage of movements as a short-term trader if the movement has not started. And this has essentially been my biggest struggle, because I've always been able, let's say, to predict essentially, which I did here, the high of dollar. I can say, oh, here we should be bearish, and then I can say a level, okay, and then potentially trade from that level. But no, I needed a way for me, because I could have, previously I just employed my model in the fundamental direction of the market. So here I would have taken a lot of losses, right? Because I would, even though I was right on the whole macroeconomic trend, okay, even though you should be right, okay, I needed to develop a way, okay, for me to essentially not be wrong, because you trade with hard stops when you're a short-term trader, or at least I do. You know, potentially some of you guys don't do it, but I do it at least. Okay, so I needed a good way to derive essentially and know when we should see reversals, and this is why I created the essentially fourth underlying dynamic, or confirmation to the second underlying dynamic principles. And this is essentially COT and seasonalities, okay? And this is something I'm just gonna go, and of course dark pools as well. So I'm just gonna show you that as well. So this is the essentially fourth layer of things. This is essentially the COT layer, dark pool layer, flow layer, okay? This is the flow and sentiment layer. And so this essentially helps me confirm that other people is looking at the same thing as me, because I can be looking at the same thing as they are they have not noticed yet, okay? And since they have not noticed it yet, they will notice it in the future, and therefore they will move the currency in the desired direction in the future. But since I have no way of knowing what they're looking at without looking at this, okay? So I need them to move the currency for me to know the trend is in. Because I can, of course, trade here. But since I trade with hard stops, right? I need a way for me to confirm that, well, they're actually positioned in the same way as I am. And then I can employ the fifth underlying dynamic, or essentially just my model, okay? So it's built like layers, okay? But before that, we have three things to go through, like in the middle steps of from second underlying dynamic to from third underlying dynamic, fourth underlying dynamic to model, okay? Which is real important, okay? And then you will have it all cleared, okay? So as you can see here, it was not just until we saw essentially COT going down here that I actually started looking for a lower dollar, as you can see right here. So it's not before we went into this bearish hedging program I was looking for a bearish dollar, okay? Hopefully that makes sense. It was not before we went up to higher COT, like higher hedging program area, that I was starting to look for a bullish dollar. And you see same thing here. It's not before we saw seasonalities aligned with the second underlying dynamic and first underlying dynamic and confirmed by this fourth underlying dynamic until I started looking at like essentially floor for dollar. You can see here. Essentially, I started looking for a floor for dollar right here, more or less. Okay. Hopefully this makes all sense for you guys. Okay. So I use these as confirmations. Okay. So I know like same other people will look at same thing as me, because I cannot move price. They need to move price for me. Okay. Now moving on and moving towards the more and most important things, okay, which distinguishes me from other people, because all of this at the end of the day only helps me interpret where currencies will go. It does not help me trade in any way, okay? You can be good at analysis and real bad at executions, okay? And so essentially what all other things, first underlying dynamic, second underlying dynamic, third underlying dynamic, and four underlying dynamics, aka confirmation to the second underlying dynamic, works, is for me that I can simply use all of this data I gather during these different levels to essentially find the most probabilistical outcome the currency will go in. Okay, so I can know the desired direction based on probabilities the market will go to, which is essentially the other calls I've done. So I've shown you like essentially first underlying dynamics, some of them, second underlying dynamics, some of them, COT and seasonalities I've shown you guys. But you guys, I think, have never understood like the probabilistical outcomes. And so, like I said, these essentially four wheels, okay, I essentially plug in, okay, and use machine learning to determine the direction of the markets. Since I'm looking at multiple different directions at once the market can go in. Since these things does not give me one whole clear direction. Sometimes they do, and that's when price has, the best price action. That's when you have the best price action. So for example here. But most of the time I get probabilistical outcomes of what's most likely. Now I'm gonna, after this video, show you one of them, or in fact I'm actually gonna do it right now. I started with essentially predicting this consolidation, And so I'm going to show you that probabilistical outcome right here, and the different scenarios I actually sent y'all and the things they were based on. Okay, as y'all can see, we're just going to scroll up and we're going to go into essentially the public analysis. Okay, and right here, this is essentially from you can see 02 08 2025. Okay, I devised using these different scenarios here. You can look at it this, right, and comprehensive outlook, and essentially this is just comprehensive outlook of what I'm looking at. Okay, based on flow sentiment, yield differential, as you can see, yield equilibriums, yield dynamics, so you can see differentials, currency correlation, macro policy, central bank bias, Fed versus ECB. This is more as divergence and convergence, and other things. Like you can see, this is yields, I think. No, crude oil as well. This was when oil was real important. And so you can see right here, essentially, I deemed that we would overall see a consolidation or a rally on dollar. As you can see, this was 02 08 2025, and it was a 60% probability of us doing that. And essentially, you can see I trade based on probabilities. Okay, mild dollar downtrend continuation 40%, and then I think I did not even, yeah, I think I just had 60-40. Okay, but sometimes I have three scenarios. Okay, meaning three different directions I may look at markets going, and I just trade and I just employ my model, which is the final layer. Okay, on these probabilistical outcomes. But now let's go to the most important thing I deem as the most important thing, and the whole thing that it all started with. Okay, since without this thing, okay, nothing of the things I've learned would even be possible. Like, I would not have learned them, I would not have known they existed, and I would not essentially know what to look for in the markets. I would not evolve as a trader. What do you all think? And I'm just gonna ask y'all, what do you all think that is? So just feel free to write in the public VC chat. Please just do so, okay? What do y'all think is the most important thing that enabled me to essentially look into these things, okay, and more or less enable me to develop these different models, okay, and perfect these different models, okay? Because of course I did not know essentially what to look for in the beginning. Like, this evolved over time, okay? So for example, how I looked at yields, this evolved over time, okay? And I think the answer is data, okay? The answer is collecting data on the process, on the individualistic trades, on the markets, and just revising and looking back on the data. Because if I have enough quantitative but also qualitative data, okay, I can just simply go back and look at the things, the similarities between the mistakes I've done, okay, and the possible improvements. Now I'll give you guys an example. You know, when I said that, no, I needed a way to confirm the supply demand characteristics, and I needed a way to confirm overall that there was other people looking at the same thing as I was looking at. So more or less creating that fourth underlying dynamics, FCE essentially. Okay, well, I only created FC because of data, because I essentially could look back on periods where I essentially underperformed with my model. So essentially here, my entry model to the first, second, third, fourth, for essentially the model STA underperformed here, because essentially I employed it in the right period. We had fundamentals pointing towards a top $1. I employed it, in a bearish stance. I mean, it just took shorts, okay? And essentially, I lost and it underperformed a lot here. It did not lose because it's independent of price, and I'm going to go through that as well. That's essentially the top layer, is the execution model. It's the model I use to execute in the markets, okay? On basis on probabilities, okay? But I needed a way to determine essentially regimes, okay? When price goes with fundamentals, or when it just goes with essentially goes just with momentum, okay? And this is why I devised two regimes, which I have talked about, okay? And the only way I was able to figure this out was with data. If I was not collecting data on the trades I've taken, I would not be able to figure out that I was underperforming in certain areas and I was overperforming in some areas. And I could not figure it out, okay? And the only reason I figured out, okay, is using data, because given enough big sample size, okay, you can figure the most shit out. You can figure out why you're underperforming. You can figure out in total why you're overperforming in some areas, and you can improve those areas and or develop models or essentially refine the areas and find the areas you need to essentially improve. And this is the key. This is why data collecting and collecting data on your trades is the most important factor in me enabling to do this whole process. Okay, since it did not start out like this and it's only grown, and that's thanks to data, because I want the most essentially reliable edge which I can trust. Okay, this was the only way I could essentially trade. Okay, and that's why I'm doing it, and I'm doing it like this. Okay, so hopefully all of this makes total sense now. Okay, now you know how it all goes together. But we're not done yet, because we have the final little layer as well. And the final little layer is the execution model itself. Okay, and the execution model itself is simply independent of this. So as I said, I trade with most probabilities sometimes. Sometimes I trade against probabilities in terms of macro trends. Sometimes I trade with them. Okay, and that's dependent on regimes. That's dependent on how I overall employ my model. So essentially I have an execution model. The execution model simply is a model which I execute short term in these regimes, in these essentially trends. Okay, so right now we had, since I showed you like 08, 02 or something like that, I was looking at a consolidation in dollar, or consolidation slash uptrend slash floor being in for dollars. And essentially this is what happened. So since then I've overall traded both sides of the markets. Okay, both sides of the markets. I'll go through the question later. So since then I've traded both sides of the markets, and I've essentially traded that regime. Okay, because we had a most probabilistical scenario based on essentially that happening. And therefore, I've been essentially taking in foreign currencies, simple liquidity sweeps on both sides. So, for example, I was looking at this today. I was looking at this long. Yesterday, I overall, or the day before, I essentially took, low risk short here. I took the low risk short here. And essentially since then I've also taken some longs and shorts essentially. So I've traded both sides of the markets with low risk since it was my August profile. Okay, and it goes confirmed. I can actually just give you guys a pure example. So the first underlying dynamic, okay, was just telling me long term we should deliver up for USD. We should be bullish for USD long term. But that's just because we're looking at the monetary policy shifting. We're looking at a 180-degree shift of monetary policy, where the Fed is much more dovish than the ECB, causing the euro to essentially be more bullish, be more essentially higher priced, because we should essentially see the dollar deliver down lower. Dollar is the determining factor since it's the world's reserve currency. Okay, so therefore we should see risk on assets and foreign currencies go up higher. So that's the long-term perspective. Second underlying dynamic told me consolidation. Okay, simple consolidation, because it has already consolidated for 60 days before, and we're 60 days behind yields now. I use a thing I call changing the state of delivery on yields. That's a concept I use to determine how many days ahead yields is for currencies. So essentially how it mirrors currencies. Okay, that's like one concept. So I use so many more, like future projections, and real SMTs on yields, not SMTs, but I just use those names. Okay, like changing the state of delivery is nothing like changing the state of delivery. I'm just saying. Okay, and then we of course more the second underlying dynamic, like I said, consolidation. Then the third underlying dynamic, we saw a big COT shift. So essentially the big COT shift confirms that, well, we should see floor for essentially dollar being done now. Like we should overall see the dollar consolidates, like getting a floor. Okay, aka just consolidating. Like it should not go down more, but it should not, it should have top of how much it should deliver up. Okay, and that's essentially the confirmation to the second underlying dynamic. So even though the second was consolidation, I got it confirmed through COT as well as seasonalities. Seasonalities, August is usually consolidated. Notice how these things intertwine, which gives me this probabilistical scenario. So still, I have a scenario that we will go up for dollar, and I have a scenario that we will go down for the dollar. But the most probabilistical outcome here is, because they position themselves, like the central bankers, in the most fundamental ways possible, like for them to look at the same thing as me, we should see a dollar, because if the same people looking at the same thing as me, we should see some movements in the same direction I'm thinking we'll move. Okay, simple as that. Very, very simple, right? And so yeah, even though we could deliver it up higher, we could have delivered up higher, and we could have delivered down lower for dollar. What we ended up doing was delivering with the most probable scenario, and that's why I employed my model, aka the STA, trading the most probabilistical scenario. And look, it has done great. You can go and check the transparency library, and you'll see the STA have done great. Okay, so this is essentially how I trade. This is how I employ my model. This is how it works. This is essentially every single little detail you need to know about how I trade. Okay. So this essentially sums up the STA perfectly, sums out that it's independent of my in-depth analysis, and essentially sums up all the things you need to know about my model. Now, what did everybody think of this? Like I said, I'm not going to go in detail about what the first underlying dynamic is. I'm not going to show you the individualist concepts. I'm not going to show you what the second underlying dynamic is. I've done somewhat of that. And I'm not going to show you what the third underlying dynamic is, or fourth underlying dynamic, okay? That's just for students. However, I'm telling you the whole process I'm going through for me to enable my model to be employed in the right, or most probable right direction in the markets, okay? And yeah, I'll just, like, why I'm saying that my model is independent of where price is delivering to is because I trade both sides. So I collect data on it both sides. So it's profitable even though I trade in the wrong regime, for example. Even though I trade in the wrong scenario, it's still profitable, but it's less profitable. And I want to employ it in the most probable scenario, since that's the way we usually deliver into, okay? So that's, usually the way we deliver to, okay? So hopefully this all makes sense, okay? Yeah, I think that's literally it. Now we'll go in and I'll show you. Yeah, it's pretty good, but it's not knowledge. It's simply my like essentially how I think of the markets. It's like I said, these calls are not for it is for knowledge, but it's for good knowledge. Like I said, I want to do more of these calls where I go in and actually talk about real knowledge, essentially, not misinformation, and essentially just talk about how I'm thinking about the markets, and how potentially you can gain something out of it. So even though it's not talking about these individualistic processes, it's not giving you so much information, it's still overall giving you the process I'm doing for me to enable me to be where I am currently. Okay. And like I said, I'm not going to go in and talk about the individualistic concepts. Those are just for the students. Okay, but let's just go through some questions, and then I'll show you and just talk about my outlook for the markets, essentially short term. So yes, I'm staying for New York session. That's correct. We're gonna stay for the whole New York session, but I'm just gonna essentially talk about what I'm looking at. Okay, so essentially now I would be pretty bearish for Nasdaq, but I'm gonna just answer this question, and then I'm gonna show you the models I'm waiting for occurring in the markets. Okay, so I collected hundreds of trades, and still I don't know how to use data correctly. Tips. So how do you currently use the data? Like, what do you currently collect data on? Because the most important thing is not just collecting, like, it depends on like what your definition of collecting data is. Like, how do you collect data? Like, what do you collect data on? Because I'll show you actually my data collector. My data collector goes in detail about what I've done in the trade. Like what essentially, not how I thought, but what I've done, like quantitatively done. Okay? And that's the most important thing. It's not discussing, oh, I thought this, I thought that. No, it's talking about, well, I did this, I used this level has that much probability of occurrence. Like this level has exactly this amount of probabilistical occurrence rate, right? Because I've collected data on all the things I use. That's why I skipped fair value gaps, because they don't have any defined edge, okay? That's why I skipped essentially order blocks. Order blocks may have some defined edge, but you just have to define, okay? Specify, and collect data on specific things, and then put them all together. And that's essentially a model, okay? And that's what you need to do. So yeah, I think this is it. So I'll show you, and